Hey, budding entrepreneurs, this is Highly Rainy, your credit renovators, and I want to talk to you guys today about revolving credit and its role in the growth of your business. So, you've done everything right, you've structured your business, you've properly developed business credit, and you're able to secure revolving credit to use to fund your business. So you got access to credit cards, you may have access to lines of credit, and so what you want to do is determine how best to use that revolving credit in the growth of your business, and thinking about like how can I best use it and using it the right way. So understanding that in business, credit plays a critical role in helping you manage your cash flow, fund your growth, and respond to unexpected challenges. So that revolving credit, being the versatile form of credit that it is, will provide you with ongoing access to funds without the need to reapply for new loans every time you need more cash. So in this video, I'm just going to go explore some of the concepts of revolving credit. I know this might seem obvious to some people, but I like to break this down because yes, revolving credit is very similar to how it works on the personal side, but there's some extra considerations you want to take when using revolving credit in business. So, of course, we know what revolving credit is, that type of credit that allows businesses and individuals to borrow and repay and borrow again up to your preset credit limit without having to keep reapplying for a new loan. We know that credit account, once it's established, the business can access the funds again as needed, pay down the balance, and reuse the available credit. And of course, we know the most common examples of revolving credit is credit cards, lines of credit, and then even in the case of real estate, home equity lines of credit, often used by individuals to access equity in a home. So, but keep in mind, in a business setting, the revolving credit is often used primarily to manage short-term cash flow needs, right? You may even use it to purchase inventory or cover some operating expenses when your revenue in your business is fluctuating. Now, revolving credit is intended to be a flexible tool that allows you to borrow exactly what you need, when you need it, and then repay it on your own schedule, of course, within the terms of the credit agreement. So, what are some of the benefits of the revolving credit used in business? Of course, the flexibility, because you can access the funds as needed, pay it back, access it again. It's reusability. Again, you can access the funds, pay it back, and then you don't have to go out and apply for a new one. You can just access the funds again. Cost control. You can use the credit whenever you want, and you only pay interest on the amount that you actually owe. So you can control your finance costs with the credit card, with revolving credit. Quick access to the funds. As I said before, many business credit cards do have cash options, and then lines of credit also allow you to tap that cash, allowing you to access funds quickly when you need them, usually within a matter of hours. Of course, oftentimes, and we're talking about not a swipe with the credit card, we may be talking about a cash advance. Now, improving your credit. Of course, we know when you have a revolving line of credit or any other revolving account, and that lender reports to the credit bureaus, and you show proper management of that account, of course, it's going to help build your credit profile, which can in turn lead to more favorable financing options in the future. Now, of course, there are different types of revolving credit that we use in business. There's the business credit card, there's the business line of credit, and then there's the vendor credit. That's credit extended to a vendor or supplier. So, with business credit cards, like you guys are familiar with on the personal side, you can make purchases up to your spending limit. You can enjoy things like You use it for travel, expenses, purchasing supplies. But the benefit is many business credit cards also offer rewards, cash back, travel points, and they come with perks like expense management tools and things that can help you in business. The line of credit, which works similarly to the credit card, but usually have a lower interest rate, and they usually come with higher credit limits. You use that for managing cash flow, covering unexpected expenses, or taking advantage of business opportunities. And then there's the vendor credit, where you can use that to purchase goods, services, and supply from suppliers on credit, and then you pay later. Typically with the common terms are net 30, net 60, which means you got 30 or 60 days respectively to make the payment. And this is a useful way for businesses to manage cash flow, keep your inventory up, and you may even save on interest. Because typically with the net 30 and net 60, there's no interest charge, or it may be minimal. So how does revolving credit work in business? When you use your revolving credit in business, you're borrowing from that pre-approved line of credit like we talked about. Now, as the business repays what is borrowed, the available credit, of course, is replenished. And then as long as you continue to make your payments and stay within the credit limit, you can just keep on using the credit. Now, with a traditional loan, of course, you receive a lump sum, pay it back over time, and then the loan is closed. So, this type of financing is particularly used for managing cash flow and handling the short-term expenses, like I said. But keep in mind, revolving credit requires discipline. Carrying high balances, especially for long periods of time, can lead to significant interest costs, so it's important to manage your revolving credit carefully. Now, there are other types of business credit, because while revolving credit is flexible and useful, it's not the only option for you as the business owner. There are several other types, such as term loans that we talked about. Again, you borrow a lump sum, you repay back over a term, and then you're done. There are also equipment and financing loans specifically for purchasing equipment, and then the equipment that you're buying is often the collateral for the loan, which makes it easier for you to qualify for this type of loan, even when you got less than perfect credit. The equipment financing can help your business spread the cost of expensive tools or machinery over time, or even technology over time. There's also invoice financing, also known as factoring. So with invoice financing, businesses can borrow against their outstanding invoices. So instead of waiting for the customer to pay that invoice, you can get cash upfront by selling your invoices to a factoring company at a discount. This can be particularly useful for businesses with long payment cycles. Then there are merchant cash advances, also known as MCAs. These provide a lump sum payment to your business in exchange for a percentage of future sales. This is a fast and easy way to obtain some cash, but MCAs often come with very high fees, making them one of the most expensive forms of credit. Then, of course, there's SBA loans guaranteed by the Small Business Administration. These loans are partially guaranteed by the government, but they are made by actual lending firms, banks that are authorized to make business loans. And then the Small Business Administration guarantees a large part of the loan, as long as you fit the profile and you fit the qualifications. The SBA loans are typically used for larger investments like purchasing real estate, expanding operations, or refinancing debt. So, what are some of the pros and cons of revolving debt versus the other types of debt? The pros of revolving debt is that flexibility and only having to pay interest on the part you borrow that you owe, and it's easier to manage your short-term cash flow and unexpected expenses with the revolving credit. However, the drawbacks of revolving credit are the higher interest rates compared to other types of loans, and the temptation to overspend leading to higher debt if not managed carefully. So what are some of the pros of term loans and the other loans? The fixed repayment schedule is easier to budget. The lower interest rates on the fixed loans, especially the SBA loans, usually make them a lot less costly. And the large amounts are usually available on the upfront and can be used for major investments using those loan types. Now, the drawbacks of the term loans and those other types are less flexibility versus the revolving credit, because once you repay the loan, you have to apply for a new one. There's a strict approval process with most fixed term loans. Many of them require collateral and strong credit history. So, each business financing option serves a unique purpose. So here's how do you choose the best one based on your needs. So if you want to manage day-to-day expenses and manage your cash flow, the revolving credit option is the best for businesses when you have unpredictable expenses or seasonal revenue fluctuation. The best for making large one-time investments such as purchasing equipment, expanding facilities, or launching new product lines would be the term loan. While invoice financing is more suitable for slow-paying clients but you need cash quickly. This is a great way to unlock cash from unpaid invoices without taking on traditional debt. If you have a business that needs fast capital but has strong daily sales, especially in industries like retail or hospitality, you have strong daily sales, the merchant cash advance may be a good option for you. But again, it should be used cautiously because it's very, very high fees involved with using MCAs. And then, of course, if you're looking to make long-term investments or you need low interest rates and longer repayment terms, the SBA loan option would be best in that situation. So keep in mind, access to credit obviously is essential for growing your business and taking advantage of new opportunities. Now, whether you're using revolving credit to manage cash flow or a term loan to finance a major project, having a strong business credit profile can open the door to better financing options. By understanding the different types of credit available and using them strategically, you can ensure that your business has the financial resources that it needs to thrive. The key to using credit wisely is by making sure you borrow within your means and repay on time to continue building your credit profile. With the smart credit management, you'll not only grow your business and gain access to larger credit lines and better financing opportunity to grow your business. So that credit is great at leveraging your income, leveraging your revenue to keep your business going and growing. So I hope you found this information valuable, and if so, please like this video and comment below. If you have any questions, you can comment and I will respond. If you would like to work with you on your credit, business credit, and secure funding and managing your business credit, feel free to reach out to me. You can go to my website. I also offer courses on these things that can help you with this and get you going with that. I also would ask that you subscribe to my channel and click the notification bell. That way you'll get updates every time I post new videos, which are fairly common. If you have information or questions about personal credit, that content is also available in my channel. So until the next time, you guys go, and hope to see you in our entrepreneurial journey. Take care.